Everyone makes mistakes. There's no successful investor who's never made a mistake. Even highly successful investors like Warren Buffett own up to their mistakes. However, you can learn from their wealth of expertise to avoid common pitfalls young investors fall into. If you want to be a successful investor, you need to have a glimpse of those mistakes to avoid as an investor. This will not only help you guard against losing your money, but save you from years of doing things the wrong way. Today, I'll be sharing with you the 12 mistakes that Warren Buffett identified in his investment journey that have proven to be a universal flaw among investors and how you can avoid them. Ensure you note every one of them. Hello and welcome to Alpha Finance. This is the channel to watch if you want to learn more about personal finance, investing, and cryptocurrency. However, before I get into the topic, do me a favor, subscribe and hit that like button because it really helps us out with the YouTube algorithm. Thanks. Now let's get into it. So what are the 12 mistakes that investors make? Number 1, timing the market. As an investor, this is the first mistake to avoid. Timing the market is an act of simply keeping a strict watch on the market moves to know the right time to buy or sell shares. Timing the market is a waste of time, according to the billionaire. Instead of that, he advised that investors should deeply research companies and their performance and also hold on to stocks for a long time instead of timing the market. According to the Oracle of Omaha, this method has helped him grow his company. He does research and identifies stocks that are cheaply priced but of high value. He doesn't bother about the supply and demand intricacies of the stock market either. What he does is look at companies as a whole and take into consideration their performance, debt, and profit margin. He also seeks to know how dependent they are on commodity markets. If the company scores the right percentage in all of these, Buffett buys them. And with time, it yields profits. This has made him a significant shareholder in Apple, Bank of America, and much more. Isn't that wiser than spending endless nights studying charts and waiting for the right time to purchase a particular stock? If you choose to time the market, tomorrow's dip may still be higher than today's pricing. In that case, what will you do? Number 2, buying at the wrong price. Warren Buffett acknowledged that he has made this mistake in the past. He concluded by saying, when investing, pessimism is your friend, euphoria is the enemy. When your head leads you to invest in a plan, you'll be dejected at the end. Instead of being led emotionally, it's important that you scrutinize the company, identify its future potential, and then buy as low as possible. Warren Buffett shared his own experience at one of Hathaway's shareholder meetings. In 2008, he bought a large stake in the stock of ConocoPhillips, believing that oil prices are likely to increase over the long term, and the company will surely benefit from it. Unfortunately, it ended as a bad investment for him because he purchased the stock for a price that was far too high. This resulted in a multi-billion-dollar loss for Berkshire Hathaway. If Warren had controlled his emotions, he would have performed a more objective analysis. This would have revealed to him that the price of crude oil has always been unstable and that oil companies are subjected to boom and bust cycles. So for you not to fall into the same ditch, get a hold of yourself before investing. Number 3, become attached to your purchase price. Warren Buffett cautioned investors not to become emotionally attached to their purchase price. He said that all the feelings and emotions tied to the purchase price will not change the situation of the stocks. According to him, stocks don't know you own them. Therefore, he warns investors not to judge their investment based on how it's performing today. Instead, they should focus on its long-term benefits. You only benefit from compound interest if the company performs excellently in the future. The performance of a company should determine whether you're to sell your stocks or not, and not just because you gained a slight increase in your purchase price. Number 4, missing the forest for the trees. Warren Buffett, in his 2018 annual letter to Berkshire Hathaway shareholders, used this idiom to enunciate investors that get too involved in the details of a prospect or company instead of analyzing the situation as a whole. Buffett noticed that investors often focus on the details of Berkshire's businesses. He calls these aspects economic trees. He argues that investors shouldn't base their judgment on these trees, but should look at the forest, which refers to the company as a whole. He wrote in his letter to shareholders, "A few of our trees are diseased and are unlikely to be around a decade from now. Many others, though, are destined to grow in size and beauty." That means if an investor's view is on a part of a company that's not fruitful, he might walk away from the company as a whole, whereas there are many other trees yielding massive fruits in other areas of the same company. Warren Buffett advised that instead of focusing on a part, an investor should consider 3 major aspects of a company. These are the management, competitive advantage of the company in the future, and price. According to the billionaire, that is all that matters. Number 5, using a lot of leverage. Leveraging is an investment strategy of using borrowed money or capital to increase their potential return on investment. To Buffett, this is not a winning strategy. One of his rules for investing is never invest on borrowed money. He also said, if you don't have leverage, you don't get in trouble. That's the only way a smart person can go broke, basically. And I've always said, if you're smart, you don't need it, and if you're dumb, you shouldn't be using it. It should, however, be noted that Buffett does not completely shut his eyes off to leveraging. He only emphasizes the fact that too much leveraging must be avoided. The more leverage you have, the greater your returns can be. However, the losses can be large as well. Leveraging your investment makes the return more volatile. If your risk tolerance is relatively low, you should avoid using too much of it. Number 6. Diversifying too much. Investors have always been advised to diversify their portfolios because it reduces risks and also increases returns. However, over-diversification can be lethal. Owning too many investments can be confusing, increase investment costs, and lead to below-average returns. That's why Buffett advises that your portfolio shouldn't take in more than 6 investments. Taking up the 7th isn't a good idea. Number 7. Confirmation bias. Warren Buffett said that what the human is best at doing is interpreting all new information so that their prior conclusions remain intact. Confirmation bias is the tendency to seek information that supports your beliefs. This can cause you, as an investor, to focus on information that supports only your opinions on an investment. As confirmation bias can sometimes be narrow-minded, it hastens your decision-making. However, you can end up making poor decisions in your choice of investment. To avoid this mistake, don't seek information that only supports your preconceived notions about an asset or strategy. Accept with an open mind any idea or data that sounds contrary. You can go as far as seeking advice that challenges your point of view. This will help you avoid jumping to conclusions. Number 8. Following the herd. Warren Buffett warns investors to avoid this trap. He said, "Be fearful when others are greedy, and be greedy when others are fearful." The mentality of following the herd also streams from our belief system. Many people wait on their acquaintances, relatives, or neighbors to authenticate their actions. They don't stand alone. That notion is not acceptable in investing. Before buying or selling your investment, you must separate yourself from what others think. Don't invest in a particular stock because everyone around does the same. It's been discovered to backfire in the long run. You can end up losing your hard-earned money. Successful people think differently from the way others think. Warren Buffett has been known not to follow the crowd, and that has helped him build his multi-billion-dollar company. Number 9. Shrinking your chances of opportunities. As an investor, you must understand that opportunities do not stay in the same place for long, and no one knows when they'll show up next. That's why diversifying your portfolio in the right way yields positive results. Many investors focus on stocks, Swedish companies, or crypto. Though it's advisable to invest in companies you understand, you must learn to identify opportunities within your range as well. Number 10. Staying active all the time. This does not look like a mistake in other areas of life. Usually, for an athlete to stay fit, he has to exercise every day of the year. To become a good opera singer, you must repeatedly practice. However, in investing, the reverse is the case. An investor that invests in all opportunities that cross his way will end up losing more than he owns. According to Buffett, an investor should behave like a baseball player. You don't want to swing at every ball thrown at you. You gotta wait for that fat pitch. In the world, doing something repeatedly leads to success, but in investing, doing a little efficiently yields profits. Number 11. Ignoring the simple and going for the complicated ventures. Warren Buffett said, "Do not invest in businesses you don't understand." This rule implies that once a business venture looks complicated and requires a lot of statistics to unveil the data, it's better to stay off. As an investor, always put it at the back of your mind that simple ideas yield exceptional results in the investment world. Buffett once said, "I don't look to jump over 7-foot bars. I look around for a 1-foot bar that I can step over." And number 12. Omissions. This happens to be the greatest mistake. Just as staying active all through the year is a mistake, not doing anything at all is an error. When you spot an opportunity, don't cross your arms as an investor. When you think it's high time that you started selling, why wait for a forecaster? According to Warren Buffett, not doing anything at all can cost you a fortune, just as venturing into a bad investment will do. Trust your instincts and act when necessary. Well, that'll be all for this video. Are you conversant with other mistakes that investors should avoid? Have you fallen into any of the mistakes shared in this video? How did you get out of it? Please don't hesitate to share your views and your thoughts in the comment section below. And as always, thanks so much for watching. And stay tuned for more informational videos, and don't forget to like and subscribe. We'll see you next time.